computer.
All right.
Welcome in, guys. A little surprise Sunday prep.
Okay.
We're gonna try and embrace this format for the foreseeable future because it works out for both me and Andrew in our time zones, and it's gonna be a net positive add for the community. So I think this is a great initiative. So as Andrew was mentioning earlier, we're gonna do a hybridized breakdown style. So I'll do some of the macro first, the background of what market updates there are, and then we'll jump into technicals from both our perspectives. We'll jump into tickers after that. So the usual thing, but except for the added macro background. So let's begin and let's start right now. So first of all, let's talk about all in all where market participants are speculating. And as of last week, after the Fed rate cut, we had a pretty big, substantial amount of people that started betting on the probability that the Fed has potentially done the rate cut too late. Now, all these kinds of speculations typically come in the bull market. You guys have heard the very famous saying that bulls climb the wall of worry while bears slide down the slippery slope, because it's much simpler for a bearish idea to take fruition because there's always a lot of speculation on both sides of the tape, and a lot of people are more fearful than greedy most of the time, or they're more concerned about being fearful because of loss aversion. So that is usually the driving psychology of the market. And in a condition like this, where we're just entering a new cycle, a new credit cycle,
Oh, like a French elf on a shelf.
Part of the market where individuals are now going to start looking at, okay, how am I going to get the most out of all of my investments in the future? That's where your peak speculation comes in. So we had a 50 basis point rate cut last week. I was betting on a 25 basis point rate cut because I didn't think the Fed would have the cojones to actually do a 50 basis point, but they did. Now, from the macro perspective, we've seen right up until the rate cut, there were two sectors that were performing extremely well: real estate and utilities. These two sectors, knowingly, they were doing well because of macro tailwinds, right? And because utilities is one sector we've been watching for a really long time. I've probably told you guys about it 4 or 5 times on different occasions because of the fact that there's been such a surge of AI and AI denominated companies that are rising, and they all require data centers, and that uses a lot of consumption of power, etc. So the market has been pretty strong on that secular trend. But I think that secular trend is now fading to make way for other sectors to take its place. So one of the other sectors that we've been seeing doing really well is real estate. And real estate, I don't think I need to explain so much here, because as interest rates come down, that makes it more favorable for people to go out and start to, have buildings, have a mortgage, or and so forth. And now, important thing to note here is, if you look at the housing data from last week, right? I don't know if you guys got a chance to look at it, but there was a huge spike, right? Huge spike in building permits, huge spike in just overall interest for mortgages. So there are a lot of people in the market that are front running. They were front running the Fed decision. It was actually on the Fed decision or the day before the Fed decision day where we got housing data. So housing data is turning out to be quite sweet. That's the reason why the XLRE has been popping up, right? This sector right here. And now, obviously, when you hear it on the news or you see something that's already on the news, it's too late. It's too late to get into this trade idea. So just ignore utilities and ignore real estate. Now, the next question is, oh, so T, but like if we're supposed to ignore them and they've run so high, should we short them? No, you don't. You don't short a secular trend when it's so strong. You only short when you have confirmation that this thing has pulled back, that it's reversed, that the trend is moving into other ways, the money flow is going to other sectors. What are those sectors? Let's go through that. So the next part of this is now understanding, okay, money has flowed into some sectors, but what is it lacking flow in, right? So I like to use the sector positioning charts that we have on Discord. These are provided to us by Goldman and a bunch of different providers. So let's go through it together. So you can see across sector groups here, Mega cap and tech positioning has come back since we were down here. We've made a nice rally back into this top half. Now, for those of you that don't know how this sector positioning charts work, let me just do this real quick so that's bigger. So these sector charts work, they kind of work like an RSI kind of vibe. This is where you get into oversold territory. This is where you get into overbought territory. But it doesn't mean that when something's here, it can't go further up, or when something is here, it can't go further down. Just like RSI, you have to be careful because it's not like it's a cookie cutter thing, and you can just like, oh, now it's the time to sell, now it's time to buy. If everybody could just do that, you know, we would be a lot richer. But however, there is one sector on this page that I do like specifically. It's energy. And you can see that energy has been consolidating very, very hard. Despite last week's rally, the sector positioning hasn't changed that much. So what I can tell or say here is that last week was probably a bunch of buyers that came in only, which caused a lopsided rally in the market. Now, adding this to the theme of everything just moving up generally last week, after FMC, the next 2 days, we had a 2% day. The day after that, we had a flat day, right? This gives me purpose to believe that energy might be on the brink of a potential reversal if this selling pressure comes back in to create some liquidity. I will be looking at energy as one of the sectors here for a potential rally or a potential rejection either way. If sellers unable to claim back higher levels, we will look at the bearish positioning. Now, the other is consumer cyclicals, right? And we've spoken about these before. So what falls in this consumer cyclicals? These are your banks. These are your semis. These are, some of your discretionary spending. These are all cyclical businesses, things that have to go in and out of a cycle. They're also one of the sectors that I'm looking at because they have been consolidating, pull back, making a potential higher low, and then we may see a rally in this. Financials, I kind of want to ignore right now because even though financials are slated to do better in terms of the macro backdrop, I think that they're going to go through some headwinds. And now the reason for this, and I'm going to take the least time possible to explain this, is that yes, when interest rate environments are cut, the first thing you see happening is more people go apply for loans, more people go apply for all this kind of stuff. But now that's not always good for banks. Why? Because the banks now have to lend at a cheaper rate. So what does that mean for banks' margins? That means that margins for their profits start getting slashed. And that's not necessarily the best, right? If you realize through the entire bear market and the best part of the past 6 months, financials have been outperforming because market has been pricing in that there will be a higher number of people that are going to take loans up or take credit up, right? And now I think the market's going to shift a little bit of that demographic into understanding that margins are going to be compressed. So understand what the speculation of the market will be, what is the forefront psychology behind the market, and then things will be easier for you. Okay, moving on to the next one. So other than that, I'm not really that a big fan of the industrial sector right now because it's consolidating. It's midway through the cycle here. Even mega cap, you can see it's top way through the cycle. The only ones I actually do like is energy because it's consolidating down here, but has potential for a bounce. Financials in the middle, but I don't really like this on either side. And then consumer cyclicals here, I like this because it's bouncing on the lower end. So I'm only taking the ones where attractive risk reward ratios are there for a potential upside, essentially, right? Materials, it's consolidating too hard on the bottom band, right? I don't really like that much. Consumer staples, not really that interesting as well. And then you have healthcare. This is another beaten down sector. But this is a defensive sector for when the market sells off. Always remember, market go down, healthcare goes up along with other sectors. So this one may make sense as a watch when hedges start to populate. When you start to see the flow favor the downside tape, then we want to look at healthcare as a hedge protection for that specific positioning. Real estate, I said, don't touch it. Utilities, I said, don't touch it. These two are overstretched right now. And then you have small caps, which are right? So only real 2 sectors that you're watching right now, well, technically 3, healthcare, right? And then you have consumer cyclicals and you have energy. These 3 are the top 3 sectors that I'm looking at for this week for opportunities. Now, to deep dive into these is a different thing. We do this in the next part of this segment. So just sector-wise, that's important. Now, as always, I like to share the clown charts. I call these the clown charts because they're essentially your hedge fund exposure. And we all know that hedge funds always get clapped for whatever reason, dude. Like they always put money in the market betting on some direction and they get fucked always because they have a big amount of money. It's just a bunch of glorified finance people that are like, yo, bro, like this sector is going up or down, right? So don't ever try to follow hedge funds because they have their own defined strategy and it's supposed to work exactly the way it sounds. Hedging, they do hedging, right? So, but it's nice to see where they're at, right? So just wanted to share this chart before I hand it off to Andrew. But essentially, COT here, what does COT stand for? It's commitment of traders, okay? And commitment of traders means you're just looking at the entire book. So here you can see net shorts in the E-mini S&P 500, so futures, was up by 107% week over week to 25-week highs, right? While the S&P 500 was up at 1.4%. Now, this doesn't mean that hedge funds are net short. It does not mean that. It just means that they're taking speculative bets to the downside. And this actually sets up the possibility for an increased squeeze scenario. Okay, so for S&P 500, you'll realize it's one way. Now, here's where it gets interesting. Look at the exposure or the allocation for NASDAQ. So NASDAQ here is a little different. You see, they're net long in NASDAQ, right? But their net longs are down 25% week over week. So yes, it's kind of in the same direction, but it's lesser on NASDAQ. So they're more short on the S&P 500 than they are on the NASDAQ. They're net long in NASDAQ, but net long less. So they've taken away, they've sold some of their long positions, and they are now looking for a potential entry.
Good night, dude.
So that's one update from here. Now, next is your Russell 2000. You can see that hedge funds net long in the mini futures were down 49%. So same thing. They're taking profits off the table here, right? And then next is your large speculators in gold, right? So net longs are up 10%. And gold has been in a big bullish cycle. Just talking to Andrew about that earlier. And you know, it could keep going, right? So, but do I want to bother about gold so much? Not really. This piece of the puzzle only helps me to understand another separate piece, which is if gold is strong and people keep buying gold, what's going to suffer? The other direction, the dollar. So gold and dollar, they're two pieces of the same puzzle. Remember, when gold goes up, dollar goes down. If dollar goes up, gold goes down. Vice versa. They're always an asset that's linked because you buy gold with dollars. Okay, so the only thing that you want to take note from here that's important is that dollar gets weaker. Okay, if that continues. And the last one, this is just oil. So you can see net longs are up 18%, and this is a nice spot. So this one plays into the energy thesis, right? That we were looking at. If indeed people are taking longs in WTI crude, which is your oil, then you know we might see energy pop if there is pressure. So that kind of concludes just macro part. We can jump into technicals after this, and then I can share more about this and how everything relates from the macro backdrop into the technicals. Because remember, they're not always going to be the same. They might be disconnected. So we have to figure that out. And I yield over to Andrew.
All right. Let me share my screen. This will stop the screen. Yes. Let me set mine up real quick. There we go. All right. All right. Here we go. All right, so we got nice little macro breakdowns. So let's talk about the plan for the week from the playbook and the data that kind of supports that to help you have more confidence in entering positions and understand kind of what could take place this week. So real quick, we're just going to go into the playbook. We'll hop over here, head over into the playbook here, and take a look at few pieces of data. So, right, so the first thing we want to look at is the actual plan, which is here. Free pass, right? Bullish is over 570, which is the biggest gamma resistance for a push up into 575. Bearish would be a rejection around this 570 area, which is where we're currently at right now overnight with futures. And then a play down into the golden pocket. And then The pathway that I thought maybe would be a move down into the golden pocket and then a move higher. Doesn't look like that's going to happen so far. We'll see what tomorrow looks like. But right now we're sitting somewhere in this bullish order or bearish order block right here. If we take a look at the week, our weekly range is the 575 area for the upside. So right here, you guys can see right here, bulls are expecting a move into 575 based off implied volatility. Bears are expecting a move down into 562. So those are kind of your weekly moves. It's not a huge week this week, not like we saw like the last few weeks, but those are kind of the expected moves right now. And you can see that the algorithms are slightly bullish. So we're actually currently in this. You can see, like, if you look at futures right now, we're sitting somewhere up in this area. So this is already coming true right now. And you can see if you take a look a little further out 5 days, you can see it's up at 572. So again, right, bullish side of the market. The market is very bullish right now. We can see that within the flow. If we go into the data, right, you guys know net flow is one of my favorite things to look at. And if you take a look at net flow right now, you can see that they're not buying puts, right? They've been very aggressive on the call side. You guys know, we've had lots of conversations around this. If they're buying calls, right, there's a good chance that we're going to see this move to the upside, especially if it's over 10. This is just on Friday, and you're 30 points over 10, right? If you look at this over the last 5 days, you're talking about, I think it's 150. Yeah, you're talking about 150 points to the upside and about 50 points to the downside. So you're about 3 to 1 to the bullish side right now. So if you want to get short and you're like, but Andrew, I have a bearish feeling about the week, a few things that you need to see happen. You need to see them start to buy puts. You need to see some type of increase in the short side of the market. Right now, the market is very bullish. So you want to be very cautious in where you kind of take risk and what you're taking risk on, just based on where the money's kind of moving right now. If we take a look at the gamma side of things, right, we can see, I was looking at coin earlier, we can see right here that the biggest level of exposure is 570, right? So what do we know? Well, if price is over 570 and you want to get short, well, you're fighting against the market maker, right? Because this is the inflection point of where we could see their actions kind of change. So 570 is the key level. You can also see over here, let's move this. You can also see over here that you're in slightly positive gamma. And if you break over 570, you go further into positive gamma, right? And in positive gamma, it's a little bit tougher for those big swings in the market that you're hoping for. So 570 is going to be that key level that we want to pay attention to going into this week. And so understanding then where the dealers are kind of sitting at, the dealers are sitting at 560 is where selling pressure is, and 565 is where buying pressure is, right? So if we go look at the dealer positioning, we can see that dealers are long 560. So if you want downside, and you have this big feeling of the market has to fall, then it has to lose 560, because that's where market makers then have to aggressively short the market in order to hedge their risk. But if the price is over 565, then dealers are short, therefore they have to buy equity to hedge the risk that they took on there. Therefore, it's going to be harder for the market to fall. So if you want the market to fall and you're like, I have this bearish feeling, then price needs to break below 565, which would kill the buying pressure, therefore pushing you down into 560. And then if 560 breaks, that selling pressure then kicks in. And that's where you go into negative gamma exposure. That's where you go into heavier selling from the market makers. That's where you get your downside pressure in the market. So right now, as long as you're over 565, the dealers, the market makers, they are buying shares to hedge their risk off of that level. And you can see if I click customers, it turns long, right? Customers are long 565 and they're short 560. So that's why we know that the market maker has to take those actions, because, right, I always tell you guys, if you want to understand this, you got to go to this chart and you need to read this chart right here, right? Basic understanding. If the investor is long, therefore the market maker is short, therefore to hedge, they have to buy the underlying asset. Okay, so if we know that the market maker is short 565, that means as long as the price is above 565, they have to buy shares over that level. Therefore, it's harder for the market to fall, right? So now if we go back to the playbook and we say, okay, well, now we know that very basic feature there. Let's go back to the playbook and take a look at the actions. We can see, we're not going to go through all that because T just did a pretty deep dive on it. We're just going to go back to the playbook here. Now you look at these key levels and you start to understand, right? As long as you're above 565, you can see price bounce right off of 565, right? There's the buying pressure at 565. There's the bounce off of 565. And now we're sitting somewhere around this 570 area, which is your biggest gamma resistance level. Now, if price stays above 565, it can move around in here. It just can't break below it, right? So over 570, we look for that push up to 575, and that is in line with the weekly move. Now, remember, I don't care what happens overnight. I don't care about pre-market. The volume is dead. It matters when the market opens within that first 15 minutes, what happens with the price action, right? So we'll see what happens in the morning. We'll see where we're at. But right now, those are the two key levels that you have to pay attention to this week. If you want downside, you need to see 565 break because that will kill the buying pressure. Therefore, dealers can ride their positions that they're short in. And if it breaks 560, then the selling pressure kicks in and we go into a negative gamma environment, which creates more volatility within the market. So that is what we are looking at this week from a data analysis standpoint. The only piece I will add before I hand this back to T to listen to him share his technical analysis breakdown is if you look at the dark pool, we did see an increase in activity. And I always say pay attention when you see an increase in activity because usually a large move is going to come. You can see that on Thursday, we saw $22 billion activity versus 12 billion was our average. And if you look at Friday, we saw an increase of 27 billion against the 14 billion average. So we are seeing an increase of activity in the dark pool. That could mean that they're buying shares. That could mean they're unloading shares, right? The only thing we know is that it means there's an increase in activity. We want to pay attention, and then we want to play those levels accordingly. So you can see here, you can look through it, right? 3 billion at 566.60. So that would be a level you'd want to pay attention to, right? And you can see when you look at my charts, right, that I keep those levels on there so that I always know where these key areas are and if I want to take risk or not around those areas. So that is where we're at this week from a data standpoint, what we're looking for. We're going to keep an eye on price action this week, see what happens. I'm going to hand it back over to T. He's going to walk you guys through his side, and then we'll get into your guys' questions. Go for it.
I just realized my mic was muted. One of the beautiful things I wanted to highlight is that, you know, even though Andrew and me might have different styles, our charts may look different, we usually end up syncing and then talking to each other. We're like, oh, okay, you know what? We're on to the same thing. And that's beautiful because every trader looks at the chart differently. And it's all, at the end of the day, how you're going to observe the bigger picture drawn into the smaller picture from the top-down approach, a bigger time frame into the smaller time frame. But just for simplicity's sake, I like to keep things, you know, like super simple, keep it just, I love the fact that Andrew gives me the information so that I don't have to do it. That's one of the biggest things that I benefit from, honestly. And here, for this specific point, you can see that on SPX, we did have some legs. We had a nice bounce after the breakout back onto the previous resistance that was here back in July, mid-July, right? We came up there to test it a couple of times, and then we broke out finally on quite low volume, might I add, and then came down to bounce for this potential extension. Now, my next target on the S&P 500 is pretty much the 23.6 extension on the Fibonacci sequence. Looking at where we were, and remember, I do Fibs a little bit differently as well. So for me, I'm looking at a huge wave because now we don't have many other waves that we can use. For example, to use this wave here would be too short to project any Fibonacci's above us. But we can use this huge wave here, the previous big run, as your next forecasting stage. So using that as the next big forecasting stage, the best guess that I would give would be that there could be some form of consolidation here to build a base, right? If the market is not sure on where speculators are going to be. And then after that, you may see in their rally all the way up to 58.60, which would be my first target. And then 59.70, which would be the second target. And then the third target is way up here at 61.8. Now, I don't intend for us to get up here until next year, because if we do get up here by end of the year, I will be fucking surprised. And quite honestly, it would be like, what the heck, right? That would be like a huge bullish move. But I will also not be entirely, like, wow. Like, because I think I've seen the market do these kinds of things enough. And that's where I'm at in terms of my mental headspace.
Hey, quick question, T.
Yeah.
Quick question. But everybody on Twitter is telling everybody that we're about to have the biggest collapse ever, like in 08.
That was a very good point that Andrew was bringing to me earlier. And I have to tell you guys, please take FinTwit or any other financial space out there with a grain of salt, okay? Prior to 2008 crisis, just understand something, that the economy was not as strong as it was right now. Number one. Number two, the job market was not as resilient that it is. Number three, we had a completely different Fed. Like, this was a Fed that was ruthless back then, okay? So we're talking about Bernanke. Like, this is one of the most hawkish Feds that we've ever had, right? So very different macro climate, and it's not the same as where we were in 2008. So anybody who tries to tell you, what if 2008 happens again? Okay, great. Well, then we get to buy more stocks at a discount in the next bull run, right? That's the best way to look at it. Just stop fear mongering. It's just not going to do you any good. 3/4 of the time, people are going to be wrong with this shit, betting the downside, because the market's always up 3/4 of the time. So I always like to think, I always bet on the bullish side more than the bearish side. And that's just a very simple sense, because statistics are in your favor. That's it. Just keep it very simple and leave it there. Another thing is that even those statistics are in your favor, you have to be smart enough to see if there's an opportunity to hedge. And we just don't have the ideal opportunity to hedge right now, because there are a couple of markers. So let me just dive into the technicals to kind of break that down for you. So from SPX, very straightforward, right? If we build a base in this area here, which I'm going to zoom in.
Yeah.
If we start building a base
If you
in
need
this
help
area,
open it, let me know.
So if we start to build a base in this area, and then we have a nice catapult from this area, we can go to the upside. But what's hindering the S&P 500 here? It's actually not the S&P 500 that's being hindered. What is it? It's actually NASDAQ, right? Because the NASDAQ is the weaker among the two right now, which is the driving force for a lot of the S&P 500 earnings. So from the macro standpoint, we need the NASDAQ to break out of where it's been consolidating. And you can see it came up to touch it last week, and now it's attempting another time right now, right? It's live. And if the NASDAQ can break up here, then you'll see a lot of your high beta stocks start to do well, okay? So very simply put, the NASDAQ has to come back into cadence with the S&P 500, break out from all-time highs. Then you're going to see a more stronger secular trend to the upside. But until that happens, the market's going to be a little bit like, oh, are we doing the right thing? Is this the right way? Like, it's going to be a lot of like tiptoeing. So the NASDAQ needs to break. That will be a good sign. The next one is your IWM. Right, and small caps, we've been talking about this for fucking months. Like, I told you guys about it when we were breaking out here, when it broke out and pulled back. There was an opportunity here, there was a buying opportunity here, there was a buying opportunity here. There's been multiple buying opportunities, and this is the other part of the market that wants to move. It wants to move because these are the stocks that have been starved for credit for so long. Now they're getting it, and half of the move has already happened, by the way. The next half of the move is just all the way back up to all-time high. And that will happen very quickly, right? When, as I always like to mention, when the market sees all green, it's all the way, right? Then you look at the 10-year yield. The 10-year yield is important because this is where majority of the credit will be funded from, right? Bonds are primarily denominated in 10-year yield, and the 10-year yield is going to give you an inclination of direction on whether the market's going to move further higher, move further down, right? So you can see we are midway from a move, right? This was your previous demand basin, as I like to call it, down here in the green. And the 10-year yield still has a little bit of space to move further down. Even though it did try to rally last week, that's why you saw a little bit of hesitance. People were, of course, betting on the fact that the Fed would have a 25 basis point rate cut, and then now with the 50 basis point rate cut, this sets up the short term for bearish bonds, right? Which will then cause bullish bonds, not bearish bonds, bullish bonds, because remember that when the yield comes down, what happens to the bond prices? They go up. So in the short run, we'll see this cycle come down and then form the base here, and that's when you'll start to see the resumption of the 10-year yield go up, and that's when you should time your hedges, and that's when you should time your down cycle or the corrective cycle, okay? So not until the 10-year yield moves into the 3.4% range is where you start even looking at hedges, in my opinion, because this will just continually put pressure on the market to act in a certain way. And then you move into the dollar, which is another piece of the puzzle, right? So dollar being another piece of puzzle back in the demand zone and is forming a base. Can it go further down? Yes, it can, right? It can break here and then it can start to go further down. The dollar has been here before, right? So what has happened before can happen again. If we break further down from here and the dollar gets below 99.50 dollar index, then stocks will be even more bullish, right? So these two over here will kind of conflict with each other, but in my opinion, this will find its base somewhere in this demand zone where it was prior, and then you'll see a bit of consolidation here. So as we go along in the next weeks, we'll give an update on this, and then we can see how it unfolds and take positions together so that you don't feel lost. Because I know a lot of you, you're still listening to me right now, you're thinking to yourself, okay, I still don't understand this. It will make sense over time, but you need to let it play out, because I know some of you don't draw the conclusions yet. What the heck does the yield have to do with the dollar? What the hell does the dollar have to do with the index? They're all interconnected. All of them are interconnected, okay? And then the last piece of the puzzle, which is the VIX, right? Which has been moving further down. Why? Because volatility has collapsed ever since, we had that spike back in, when was this? August, beginning of August, right? And now that OPEC's gamma has unclenched, you're going to see a resumption of hedging positions. This is the reason why you don't want to hedge right now. It's not the right time. You wait for the conditions to be right, then you hedge, okay? When things are stretched, then hedges become cheaper. So I fully think that people will keep getting squeezed higher, 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 until the point is where people will be in max pain, and then the actual down move happens, which is still, I would say, at least a month or so out. So don't rush into buying hedges and listening to the fear mongering. The trend is up, it's bullish. Just had a bullish break on NASDAQ. Don't overthink it. Be bullish until you're given reason to think otherwise. And that's very simply from the technical perspective, that's all you need to understand. SPX is in an awkward phase, it's broken out, and it's kind of like, where's NASDAQ, right? And so wait for all of this to happen. Market has to catch up, sentiment has to clear. All of that happens, things will be much more clear. In the meantime, there are a lot of setups that you can take advantage of this, so let's dive into those. And I hand it back to you, Andrew.
All right, so let's get into some tickers. I see app. What other tickers do you guys want to take a look at? In phase. All right, let me share my screen with you guys. There we go. Let me pull the chat up real quick. Tesla. Okay. Just to add real quick to his points on the NASDAQ, right? You can see here, if you look at QQQ, the gamma buildup, right? Over 480 is good. 490, you can see 500. So you can see the levels starting to build. Obviously, you want to see those get higher than this one, right? To pull into that area, but not quite there yet. All right. Let's start with app. App. Okay. All right. Biggest level is 130. Let's go check this out. No. Oh, there we go. Oh man, this thing is ripped. Let's move into a longer time frame here. Oh wow. So are you bullish on this? Let's see. Biggest level is 130 is your gamma. Looks like it's basically going to tap this. You could short on a rejection of 130 because that's going to be your resistance. But if it gets over 130, you're going to look at more upside there. I mean, I would say you're late if you're trying to get long on it. For me, I like to enter things in fear. Let's see. Biggest level. So dealers are long 125 by their largest level. So dealers are long 125. So they have no actions above 125. Selling pressure kicks in below 125. So what I like to do is come here, mark 125. Doesn't have to be perfect. Just get it close, whatever. Mark that as selling pressure. That red. And that green. And so now I can kind of go into a smaller time frame and take a look at it. And so you can see you're slightly above it. So below 125, you could short, use selling pressure. It might come up and tap this 130. It's a little overextended though on a short-term basis. So great entry would have been right here at this like 90 area. And you can see the old gamma resistance was around here where it bounced right off of it. So you can see the buyers stepped in right there. So you can see it came off of that old gamma resistance and then the buyers stepped in and then you got your move. So it's kind of what you're looking at here. 130 is going to be your key level. In phase. So in phase, let's take a look. This one real quick. I have it in this box. Long term, short term is definitely different, but long term you have this order block here that's been holding it down this whole time. So until you clear this area, you don't have the big move. But let's take a look at the data real quick, see if anything changed on it. So you can see there's a clear support here at 110. So as long as you're above 110, you're in a pretty good spot. As long as you're above 110, you're in a pretty good spot. Let's see if there's any dealer positioning on this. What's the best way to see or identify buying and selling coming in? I use an order block finder to help me understand, but then also just understanding where the gamma is and the dealer's positioning is also how I gain that information. I don't look at the tape so much. T looks at the tape.
I wouldn't touch end phase right now. Just setup wise, not really ideal in my opinion.
Yeah, I was gonna say I don't see. Yeah, 110 is selling pressure. So below 110, there's a short, but above 110, 11, 120. I don't really see anything. There's no gamma to the upside, so you can see there's no position building. I'll show you when we get one that has a good position building. But you can see there's nothing too big here. So 110 is your biggest level and it's support. So you can see here that it bounced right off of that 110 area. But this 120 is pretty much gone. And it looks like I'm going to move into a smaller time frame just so I can see. But yeah, so it rejected the golden pocket. So again, me and T have different fibs, but the same concepts. So you can see it rejected the golden pocket and then came down. It's just chopping back and forth. So I guess, let's see. I think give another bounce right here in the golden pocket. Let's see. Not really. It overshot the golden pocket there. And then I think you overshot it again here. And here you kind of rejected the golden pocket. So it's not my favorite setup. I kind of agree with T. I don't see anything that I really enjoy here from a short-term perspective. Let's see what else we got. Tesla, PayPal. Yeah, so PayPal was 72 was the key level there. I think it was, or 70. Yeah, so you can see there's a clear build up here at 80. So you see how the levels just keep building. So 80 is going to be your key level here. You can take a look here at the dealer positioning. Let's see. Oops, past it. Should be right here. And you can see that the dealers have been getting squeezed since 60 and 65. So, it's a little bit late. There's the 72.50 that I was talking about. So you can look at PayPal. I think I have a target. See, there's the 70 level. That was the old gamma target. We broke through that. And then he's pushed up into 75. And so over 75, you're looking for that 80. So let's mark it. Right, and there's 80 right there. That's going to be your new gamma target. Over the order block here, which is a good sign. So you can see here, nice breakout. There it is. So you can see this is, again, you're kind of a little bit late, right? Here's the bottom of the wave. Here's the top of the wave. Here was your entry off the golden pocket. Now you're kind of pushing into the extension. So you broke the high here. You broke the 75 gamma. Now you have this 80 target. So I would assume you're probably going to push up into this 80 area if the market's bullish. If you break 80, then you have your fib extension from that wave at about 83.23. So you're kind of in the extension phase. It's probably the tail end of the move here, and you probably get some type of retrace. So, but it's a good breakout here. Again, just a little bit late to the party. I wouldn't be jumping in this personally. Tesla. So Tesla had a great move, but it did reject the golden pocket. So here's again, right? Same setup. You mark your wave down here. This is the top of your wave. You hit the golden pocket there. So not where I would be getting long. Best place to get long was down here off of the golden pocket. Again, you can see though that so far it's following the wave structure that we've kind of expected. You need to get a close over 250 for a push up into about 270, 275. We take a look here real quick. Is there anything building? Yeah, you can see the biggest level is 250. So you got to get through 250. It's right there. And then there's 300. So 250 is kind of your big wall right there that you got to get through. And you can see it right here at the top of the golden pocket. So this is gamma resistance. So over 250, you look for more upside. You could short here if the market seems bearish to you and you wanted to short. Your stop loss would be above 250 though. So it's kind of, it'd be like a longer term position, not anything short term there. You take a look here at the dealer positioning on this name. Let's see. I like Tesla. So, but I'm in it long term, not short term. Where's my dealer position? Here we go. Let's see. Okay. You can see here, I mean, clear as day. Dealers are long 230. So as long as we're above 230, I am not bearish Tesla.
So one small thing, Andrew, Tesla has a catalyst event coming up, I think
October, right? They have the robo taxis.
Exactly. So heading into that event, I fully expect a lot of speculation on this one.
Yep.
247, 248 was like my ideal target for a rejection, but last week we got it earlier on a weaker NASDAQ. So Tesla didn't actually get up there. But I like this pullback on the way down here. If it can get back into 230 all the way to 235, that small range would be ideal entry if someone's looking for a bullish play into the robotaxi event. I'm talking about catalyst trade, not like a swing trade. We managed to catch a breakout last week on Thursday. That was a nice one. But I think I agree with you in the short run. I think this one might throw people into different directions, just speculating, and then end up based until the event. So a bit of, you have to exercise a bit of restraint with Tesla right now.
Yeah. Short term could get a little nasty on this one.
Yeah.
But just understand that dealers are massively long this 230 level. So unless the dealer wants to massively hedge this position, they're going to buy off of that 230 level. Because if it breaks 230, now they have to hedge their risk, and that's going to create more selling pressure into the downside. And so if they don't want that, they're going to have to step in. So just keep that in mind. 230 is kind of your key level here on Tesla. Apple's a clear as day. Like Apple's as easy as it comes. It's 230. You can see the candles closing below 230. They can't close above. A close above 230 would be fantastic. I'm assuming we take a look at this, right? 230 is obviously going to be, I hate the gamma levels for Apple. It always looks the same. It's always crap. 230 is obviously the largest level. It just kind of moves with Apple. It never has like a clear level showing you what direction. So 230 is going to be clear as day. We can take a look at market maker positioning on this one. And let's see. You can see they're steadily building bullish positions right there. And then we'll take a look at the market maker positioning, and they've been long 220 and they're long 240, and they've been getting squeezed off of 222, 225, 227, and now they'll get squeezed at 230. So they'll get their largest, there's buying pressure over 230. So I would say over 230. I wouldn't mind it long. Under 230, if you're getting long under 230, I think the question you have to ask yourself is, why do you believe it's going to break 230?
Yeah.
That would be the question you'd have to evaluate yourself on, what do I feel that it's going to break 230? Because dealers are short here, right? So over 230, that buying pressure would kick in. And that would be nice. So over 230, I think you could easily push up into the high, which is that 237.
I was looking at some data, macro data on this also. I feel I should share. Apple tends to perform really well after its iPhone event. Like after its iPhone event, it tends to perform really well historically. However, from the technical perspective here, I don't see the case for entering long yet. I just simply don't see the case. 215 would be a much better spot to get some long exposure. That's also close to your bullish order block, which is below you.
Yep. Down here.
Yeah, right, exactly there. I wouldn't want to go long here just because risk to reward ratio sucks. So
yeah,
that was my important metric there.
From a golden pocket perspective, like if we were to get a DTEF situation, which stands for double top emotional fuckery, we would get some type of pullback here into this golden pocket down into 220 and then come off of this. And that traps all the bearish people who are like, oh, double top, we caught it, right? And then does something like this and totally fakes everybody out. But over 230, if you do feel like you want to get long Apple and you like Apple, over 230, you at least know that you're over the largest gamma level, and there's also some buying pressure there on those 4 different contracts that could push this up into the high. And that would support, right, QQQ, right? We go back, anytime you start to look at these mega caps, right, the question you have to ask yourself is, what would it do? That would support QQQ breaking over this golden pocket. And when you break the golden pocket, you usually make a move up into the full extension of that fib. So that would support, right, the NASDAQ, right, and tech kind of waking up and making this move back up into those highs. So that could be another thing that you guys look at if you're looking to take a position, a bullish position on Apple over that 230 level. Google is one of my favorite setups. So I'm going to move this into the weekly here. This is where I like to enter positions. As I said, I like to buy into fear. This came right down into the golden pocket on the weekly off this massive wave here from 130 to 192, off of this 150 gamma support level, and had a great bounce so far. So if this can clear kind of this area right here, this 170 area, then it should make a move up into this golden pocket up here, which is about 180 to 184. So this has been probably my favorite. I also like to look for the lagger. And if you're talking about like the tech sector, right, this one's been the lagger due to the news of the government kind of going after them and dismantling them. But probably not going to happen. And so Google here could wake up and be that driving force that pushes, right, and gets the market kind of moving here. We take a look at this on the gamma side, we can see clear level here, 165. You got to clear that. And what you want to see is you want to see this 200 level start to build up. So it's not there yet, but you can see that it's kind of the outlier here, right? As these levels kind of lose, this level starting to build. If this level starts to build up like this, then this becomes kind of clear as day as the target, as they're kind of pushing towards. So I would say over 165 is your key level there. We'll take a look at this from a market maker's standpoint. Come on, there we go. Well, we don't like that huge buy of puts right there. Let's see. Yeah, so dealers are short 160. So dealers are short 160, which means they get squeezed over 160. So over 160, we like it. It's currently sitting slightly above 160. So let's add some things here. We're going to get rid of this guy real quick. That's kind of old. 165, we know, is the gamma resistance. So we're going to change that name real quick. And then we know that 160 is the buying pressure. So now we can look at this. Right. And then I like to go into like smaller time frames just to see kind of what the price action look like off that level. And you can see once it closed above 160, then you just kind of got this buying kicking in. So as long as you stay above 160, then you're okay. Break 160, and you're probably going to get some type of pullback. So, but over 160, that buying pressure most likely pushes into 165. You do have an order block right here that you're going to have to watch out for. You want to clear that. So, but from a longer term perspective, like if you look at this on the weekly, I do like this setup here. Back testing off the previous high here from 2021. I mean, this was your perfect little DTEF setup here. You had the top here and you had the top here, and then they kind of shook everybody out and then ripped it. So NGG VRT. Don't know much about this one. Okay. Well, I mean, you bounced off the golden pocket. I know we talked about this one, you know, in direct messages. You bounced off of this. Tough situation here is you did hit. You're slightly above the golden pocket, so I think as long as you stay above there, you should finish your move up. I don't know if you get much information on this one. NGG. Yeah, you don't get much information on this. There's not a lot of flow. So you're gonna have to just kind of, I would start to scale out and take some profits because I know where you kind of bought in on this one. And leave some runners, just kind of leave your profits running. Yeah, so you got nothing to look at. There's no name there. So you're gonna have some type of resistance up here, most likely. So you need to get at least a close over 74.57. You're gonna have to close above that high. But it's a great trade.
I was gonna mention for everyone who puts tickers in the chat, it would be helpful if you also put your bias down. Because when we know what your bias is, it's a bit easier for us to try and help you to see what the opposing idea to that is. This helps you avoid confirmation bias. A lot of you are asking, so hear me out. A lot of you are asking for ticker breakdowns to help you confirm your bias, but that's not what you should be doing. You should be doing the reverse. You should be asking us to confirm the opposite to your bias so that you can have a more pure short bias. Do you guys get what I'm saying? So try to have your ticker requests together with your bias, like let's say NGG and then bullish or NGG bearish, right? So then we know, okay, this person's trying to go bullish. How can we help them validate? I think it's more efficient for both of us, in my opinion.
Yeah, 100%. VRT, you're in the golden pocket, so you already know. You guys know the saying. I don't like risk here. You should be taking risk off the table unless you're long term. Then it doesn't matter. But if you want more upside, you're going to have to close above the golden pocket, which is 98. 15, I can see if you've got anything there. Not really. As you can see, there's support down to 85, which would have been a good entry, but nothing above. So you're not really looking at much there. You're going to have to see if it gets through the golden pocket. You're going to have to make a decision there on whether you're going to hold that or you're going to scale out. But you did catch most of the move from, I guess. Let's see. I don't know if you have anything here. Are you there? You got a little bit here at 95. Dealers were long 85. That made sense why it bounced there, why there was that support there. So yeah, I mean, not a lot there. You're in the golden pocket, so you're gonna have to close above 98 if you want continuation into the high. Other than that, you could reject here. Square just posted this one. I like it long term. Bounced off the golden pocket. You need a close over 70, which is your gamma resistance. I already posted this. So this will be an easy one. It's going to be quick. There's 70, easy. You don't have to overcomplicate it. Got to get through 70. Pretty sure I posted the dealer positioning on this one as well. Again, I think this one's pretty easy. Let's see. There it is, clear as day, 65. Over 65, you have buying pressure. Under 65, you're screwed. So needs to clear 70, needs to stay above 65. You're kind of in between. Over 70, I think you get to the golden pocket. Not doing Tesla again, already did it. Apple already did it. MU has earnings. So what do we say about earnings?
Yeah, this
Earnings are 50-50.
avoid it at all costs.
Doesn't matter what I say. So earnings are on Monday. Good luck if you're playing them. But you guys already know I won't look at ticker breakdowns for earnings. ACN long-term 2025 or 2026. I don't know what that question is too. Oh, forever. Amazon. ACN. I don't know what that is. ACN. And
Accenture. Oh, that's a consulting firm.
looks like it rejected a golden pocket. Yep, rejected the golden pocket. So you are kind of in funky land here when it happens. You could short, use the golden pocket as your stop loss, and then your next golden pocket is down here at 303.296. I'm assuming there's probably not much flow
Pretty
on
big
this.
bearish engulfing candle though.
Yeah, I was gonna say, like, I would say this would be my target. I'm gonna check the data here real quick. But you rejected right off the golden pocket. That'd have been a great entry if you entered that golden pocket right there. ACN. Yeah, you do have some exposure, 360 and 350 and 360. I bet you it rejected off those. Watch. There's 350. There's your rejection. And then 360.
Accenture is forming a downward wedge / pennant. So I would say let that play out. Like you see that that spot where it rejected from the top, you could draw a trend line resistance down, and from the bottom,
okay,
draw a trend line resistance from the previous bottom that like way back.
Oh yeah, off this one, and then a squeeze point.
Exactly, and then you have like
Yeah, I got what you're saying.
So that's how I would look at that one because it's just easier. And then if you don't break the pivot on either side and confirm, then you don't have a trade. It's really simple.
There. Yeah. So I mean, you could short 350 would be your stop loss. 360.
Yeah.
Over 360, you probably go all the way up to 388.
Yeah.
So, but this looks like it probably wants to come down into this golden pocket here.
Yeah. Yeah. 300, 290, 295 to 300 is where I'm looking at potentially for a bounce if it breaks all the way down.
Yeah. All right. Let me get rid of these trend lines.
What was this one? ACN. And then you have
ACN. Amazon is one I really like. I know T really likes it as well.
And it goes
very similar situation, but it broke the golden pocket. So as I just told you guys countless times, when you break the golden pocket, usually you'll get your push up into the high, which is 200. So if that was the case, I would love to see gamma building at 200.
Yeah.
which is what we see, right? You see the gamma building up to 200.
And there was
So-
this news last week as well with this one, Amazon, data center collaboration with Oracle. And then, you know, we're still waiting on a big one from Amazon. It's AI push, which they
Yep.
had some like chatter about it. I think what, 3 months, 2 months ago. I think right before I left for my wedding, I saw something about how they're releasing some AI thing, but then I don't think it's come into play yet. So that one's a catalyst, but this another thing I want to add is it goes along with our sector thesis because this forms the consumer cyclical category,
Yeah.
and it may be on the same trajectory as Tesla eventually.
Yeah. Yeah. I like this one. This has been one that I've been acquiring for quite some time, as I've told people.
Yeah.
So this is definitely one that
Valuation is $230 as of 9/8. So I just did a valuation 2 weeks ago. This one's about $230 fair value.
Yeah, and you can see it bounced right off of the order block, right? Like this is a weekly order block. I like to look at longer time frames because it gives me a better evaluation. I know a lot of you guys like to day trade, but for me personally, I like to look for the bigger moves. So I like to look at longer time frames because that gives you stronger confirmation. So you can see here there was a long-term order block down here, and it came into this area and literally got bought right off of it, right? So that's a strong confirmation of that move. And so now you broke this golden pocket off of this wave. So as long as it stays above it, you're looking for this push up to 200, and that's where the gamma is. So it falls in line with what I've been kind of expecting there.
These are the kinds of setups you got to pay attention to. Amazon right here is a good setup.
How do you go about potential swing trade? Do you ideally take calls that has a minimum 2-week time frame? It depends on the time frame you're looking at for that trade, as I always tell people. So if I'm looking at a weekly, then you have to take, a few months, right? Because it's going to take time. Each candle's 7 days, right? So if you're looking at a 4-hour chart, right, that might happen in a few weeks, maybe a week, right? It all depends on the time frame you're looking at. If you're looking at a 5-minute chart, it's going to happen that day. Yeah, T answered it. Okay, cool. About 11 shares below. Nice job. Okay, we already did VRT. Buy Apple puts at 233 area. Just wanted to know. Yeah, so if you bought puts, the only thing you're concerned about is if price gets over 230.
Yeah, 230 is your pivot there for Apple.
Yeah. How do you find the gamma resistance? I use quant data. Square, already did Square. Sold half in GG, kept runners. Great job. Learned great. Andrew, when price reaches into your GP, what are things that you look for to invalidate your thesis? Gamma. Where does the gamma start to build up? Where the dealer is going to step in as sellers, right? Is the market overextended? It could be a lot of different things. AMD bearish. 160. AMD bearish is easy. 160, clear as day. Over 160, you probably get to the golden pocket. You can see these weekly candles have not been able to close over 160. So 160 is your clear cut level. And you can see it's the biggest level right there. So 160, as long as you're below 160, you're okay. You get over 160, you're in trouble. AC and bearish K. Golden pocket, we already talked about that. Melly bullish. Melly over, I want to say it's 2100. Yeah, I mean, you're still technically in price discovery. Yeah, I mean, as long as you hold 2100, you still got 2200 building right there. So you lose 2100, you're in trouble. It can go all the way down to 2000. But over 2100, you could still get to 2000. So 2100 is going to be your key point there. I'm guessing maybe there's dealer positioning off of that level.
Yeah, this one is interesting. Melly.
Yeah, because the price discovery.
Yes, but then also this like break and then consolidation.
Look at it. They've been buying it though.
Yeah, I think it needs a pullback. A pullback before you can enter long. If you
Yeah.
enter short, this looks like an ideal moment to start building a short position, but I wouldn't go all in yet.
Yeah, it doesn't look like there's any information updating. I'll have to come back and double check it for you. Doesn't look like anything's loading though. So I would say I have it in this box right here for the short term. That's kind of where you're at right now. You can see it's just sitting right on that 2100, and that 2100 is 50-50, so it's not a good risk to reward. But it is in price discovery, so you know, as long as you're in price discovery, I mean, you can always still hold. You never know what's going to happen. McDonald bullish
McDonald bullish is a tough
needs
one.
to clear 300.
That's a tough one.
These are tough ones. So, you know, I get a lot of questions about stuff like this. This is where it gets pretty hard, right? Because 300 is right here. It's your biggest level. So it's clear as day, right? And then you can probably look and see. And this is where people get into a lot of trouble, right? Because they enter positions before the play actually happens.
Yes.
And because they're afraid to miss it, right? And so we're going to take a look real quick. 285 was the buying pressure. So it's been bullish since 285.
So I'm realizing that a lot of the setups that have come in through requests today, and remember, there's nothing wrong with this. All I'm saying, I'm putting my analysis out there is a lot of you choose to chase setups that are already at all-time highs and are just on the brink of breakout, right? That's very counterintuitive because you're letting your loss aversion shine here. See, when you are unable to properly look at the opportunity cost in this scenario, look, McDonald's is a prime example, right? You're looking at a stock which is at the end of a very big bullish bounce. From a key level, me and Andrew literally have the same part marked out on the bottom. That was the time when I think we were both talking about McDonald's and we were like, hey, if you want long-term shares, this is a spot you should get some. When it was back at 250, right?
Yeah.
Now when it's at 296, you have to wait for this thing to come back down if you want to go bullish. If you want to go bearish, I get it that this could be a potential spot for you to take a bearish positioning, but I wouldn't try to position myself to take a bullish positioning here because you do not know what can happen if McDonald's reverses against you. And considering the market, you know, is hopped up on happy juice right now, whatever pullback happens, right? So then your position gets drawn out. And then especially if you choose the wrong strike and the wrong expiry, you're dead. Your position's dead. So don't put yourself into these positions is what I'm trying to say. Find the ones which have really good risk reward ratios. Keep pivot points where the move has not happened. There are some I can share with you guys. I'll be putting it on the snipers as well when Andrew is done with his. I'll share with you my top conviction trades for this week. And you guys can have a look at what are the caliber of setups that I look at that are nice, good setups that you want to pay attention to.
Yeah. I got one more to go through and then T will walk you guys through. So what I would say here in this situation, right, is we caught this move, right? And I know a lot of you guys caught this move because we talked about McDonald's, you know, a ton during this. This would go into price discovery. So yes, over 300, go into price discovery. You guys know my number one rule. Don't short stocks in price discovery.
Absolutely.
It usually doesn't end up well for you. But if it doesn't break 300 and you go long, that's a very risky move because you are betting that it's going to go into price discovery before any investor has pushed it into price discovery. So that is just one thing to think about when you make that decision to get into a position before the breakout is actually confirmed, because remember, your 2 to 3 contracts don't mean anything to the actual price of the stock, right? The investor has to find value in the company that you're buying to then push that price into the level that you want, or the market maker has to get squeezed to push the price to the price that you want. So always remember that when you enter a position, right? Just because you bought a contract and you think the price should go to somewhere doesn't mean it's necessarily going to go there, because some investor has to come in and buy the stock up to those levels in order for you to make money off your contract. And then the last one was XOM, and I 100%. I love energy. This one, you know, I'll move into a smaller time frame. 115 is the clear level here. This has 3 clear levels: 110, 115, and 120. I like risk around any of those levels. This one would need to stay above 115 if you want to play bullish. If it broke below 115, then you could short. This one has the cleanest levels. You'll see when you look at it. It's always those 3 levels. They just don't change. So you can see there's support at 110, there's resistance at 120, and you can see 125 is starting to build. And so energy continues to look really good as a sector rotating into. And XLE, I posted the chart, T posted the chart, to his group. You can see this one again. I like the weekly. You can see the setup here, and it's very similar to the last few times. I was just telling T this. I was like, dude, this looks identical to the last few times that it's done this.
Pretty
and
much.
every time it's had this big long extension just come off of it, right? And so I like energy over 115. I like XOM. I think 120 is the target. Over 120, 125 looks clear. This is probably one of the sectors that I probably lean towards the most right now.
Yeah.
All right. Thanks for all the questions, guys. Hopefully that helped. I'm going to hand it over to T. He's going to walk you guys through some setups that he likes, and then we'll call it a night.
Yeah, that's not. I'm not going to go through so much of them. I'll put them on the snipe list so that you guys can have
Okay,
it
cool.
all just neatly arranged so that you can do it at your own time. But because I also don't want this to drag too long. But I'll share this. What I was talking about earlier is the important part, which is don't take setups just because something is long, or don't take setups just because you think that there's a move coming. You have to weigh across the possibility that something will happen. So at the beginning of this webinar, we spoke about 3 sectors: energy, consumer discretionary, and the third was healthcare, right? And healthcare was a hedge if the market goes into a corrective phase. So that one is more of like on watch. But then for energy and for consumer discretionary, you really have only a handful of stocks. So for consumer discretionary, your main focus should be Amazon and Tesla, which we've gone through both of these for this week. Amazon's a slightly better setup than Tesla because Tesla got rejected at a very key level. Here you can see last week, obviously this was our entry and exit for the day trade, but we were expecting it to come up to 248. They didn't do that. Tesla tends to do that. It will not do what you want it to do. And then with Amazon, you have a more convincing setup, a more higher caliber setup, because it actually bounced strongly on the golden region, right? The golden pocket area, which Andrew talks about. And so this one is one of the ones that I'll be watching very carefully along with XOM, right? So very rarely do you see 4-hour tweezers, first of all, right? And then you have a tweezer that is right above a demand zone, which was right here, right? Which is a nice spot for a potential bullish entry if energy can get legs. And then you can play it up into the 118, 119 position. Now, granted that this is far away from your next demand zone down here, you will have to drill into a smaller time frame here, like the 15-minute, to get the right risk to reward ratio set up. Okay, because if XOM breaks below 113 or so, like 113.50 around this area, right? Then this setup is, for the bullish setup, is invalid. Then you have to look for a bearish setup, because then it breaks below, it starts to reject, and then goes further down. That would be the bearish rejection. But if we can get a bullish break or a gap up early and then a pullback to confirm that this is new demand, then I'm happy to play this for a extension into the 118 and 120 range, which is this area here. So I'll be happy to take that bullish position. The other counterpart to XOM is going to be Chevron, which is CVX. Now, I think it's CVX. Is it CVX?
Oh, you're still on XOM.
Oh, yeah. No, I was going to see Chevron. And Chevron has got a slightly nicer setup because it's just coming off a bounce. So risk reward ratio wise, this is a nicer setup. You see what I mean? Compare this to this and look at where your risk assignments are. This is what I mean by choose the right setups. Although I see a reversal pattern here, I would still be inclined to take this as the long position because it's better risk reward ratio. So don't let loss aversion screw up your chances, okay? So that's your 2: energy, consumer discretionary. Now, moving into healthcare. I've been talking about J&J for weeks now, almost 3 weeks. This has been on my radar. Have I seen a bullish bounce that I want to play yet? Not yet, because I wanted to see this pull back, and rightfully so, it has been pulling back and finding demand at the previous breakout at 163.50, which has been your previous resistance, and this has been holding really nicely. So if we can get a push up here, then this would be a nice swing trade. You see, this is a swing trade idea, completely different from your day trading style. So if we can get a bounce here and continues to consolidate here, a break above 165, 166, 167 in this region with good volume, good momentum behind it would set me up to take this bullish positioning. But why would I take this bullish positioning? Only if SPX rejects and starts moving downward, then I want to take a bullish positioning in JNJ. Okay, so very simply put. Now, very quickly, two other setups that are part of technology / package software. CRM, another good one. If it can break above this key area here at around 270, right? This should be on your radar for this week. There's been some chatter about the stock as well. Coming up from a very nice downtrend, reversed into an uptrend. This is your validation right here. 265 to 270 is going to be your main zone. If it can break this, it's going to get up into the 275, 280, and then eventually into 287.50, which will be your main key rejection point. So this is one setup I would watch. If it rejects 265, 266, it's coming back down to 258 and then 253. So very simple setup. You can play either way, right? And then for the other one is Shopify. Look at how similar these setups are. But you realize that it's very different from the likes of the setups that were asked earlier, like McDonald's and such, right? Why? Because these are not trading at all-time highs. They're not in the brink of price discovery. These actually have upside, clean upside with big gaps to fill, right? You realize that. These are the kinds of setups you should pay attention to, because if as long as the stock can break and form demand in this new area, then you will see a nice push to the upside. Okay, so just wanted to show you examples of good setups versus not so good setups, because I think that's a key point. This will be posted on Discord. I will put it on the snipe list, and then you will be able to get your stuff.
Sounds good. Well, I think that's going to wrap us up, dude.
Yeah, that's about it. I mean, I hope that this was helpful. So this is kind of like the new format that we want to get into every week. Hopefully it's helpful for some of you guys. If it is, let us know if you want us to do something differently or if it benefits you in a different way. We're always happy to do anything for the benefit of the community. That's exactly how the BUTFL and EGA collaboration anyway started. So as long as it benefits you guys, we're happy.
Awesome. Well, I will let you guys get some sleep. T's going to start his day.
Yeah.
I'm going to get some sleep.
Yeah.
I know a lot of you guys are on the East Coast, so you guys will get some sleep. So for the rest of you, have a great week. Good luck. Be careful, right? And if you guys have any questions, always feel free to reach out. And we'll talk to you guys all next week, next Sunday. So we'll do it again next Sunday, same format. So hope to see all you guys again. And you guys all take it easy.
Thank you, guys.
Right. No.
All right, I'm gonna head out of here now.
Sounds good. We'll talk to you later.
Yeah, have a good night, man. Rest well.
You too. Late.